Recipes for technical trading success in Cook's Kitchen.
Are you looking for a reason to sell some stocks and take some profits in this strong bull market? I've got one for you today. It's my thesis I call the perfect storm for stocks. On January 30th, I told subscribers I was looking for a perfect storm for stocks based on three things going in a vicious cycle here, so to speak. First one, S&P earnings estimates fell over 10% from the highs in August. This is 2015 estimates of $133 for the S&P aggregate to $120 by mid-January. Second element, the surging U.S. dollar equals more pain for multinationals. Remember, when the ECB finally launches QE, that euro exchange rate dropped from above 120 down to 113. That's a big move since the euro is almost 60% of the U.S. dollar exchange rate. And the third element is the Fed rate hike liftoff, meaning beginning the process of normalizing interest rates. Looks like a great chance of getting started by June because on Friday, January 30th, one of the super doves, James Bullard, president of the St. Louis Fed, was on Bloomberg TV saying zero rates are not right for this strong economy. And remember, he was the guy back in October who said, hey, we could do more QE. Now a dove is saying, you know, we need to get off of zero. Okay, so all these elements combine. And so this is the vicious feedback loop. And so we're looking at, hey, we're getting this tax break at the gas pump, so to speak, but can that make up for the earnings evaporation due to the oil bear and the strong U.S. dollar, which we were already hearing was hitting multinationals? We were hearing it in earnings pre-announcements and then the actual reports and the guidance that, hey, we've got currency headwinds. And with 45% of S&P profits coming from overseas, you know, you can do the math there. All right, and then Bullard's get off zero now only makes the dollar stronger. So that's the feedback loop. So let me show it to you here. So my graphic didn't turn out as well as I want, but the idea is, hey, a sooner Fed liftoff makes the dollar even stronger now, and especially as ECB QE unfolds and the euro heads to parity like everybody thinks it will, which probably means it won't. But then this stronger dollar hits U.S. corporate profits even further. And then if U.S. stocks have been a safe haven, which they have, you know, we've got money gravitating towards the U.S., towards the dollar, towards our stocks, towards our bonds, that may only have temporary effects, you know, to hold stocks up when you have estimates still falling and rates rising. Lower earnings estimates, higher interest rates, not a good equation for the market. So this is my perfect storm. So on January 30th, I showed my subscribers this weekly chart of the S&P, highlighting how the market was losing some momentum and doing something it hadn't done for a long time, sitting on its 20-week moving average. This dashed line is the middle band of Bollinger Bands, and on a weekly chart that would be the 20-period moving average. 20-week, almost the same as the 100-day. So what is the market doing? Keeps piercing it the first week of January, second week of January, piercing and bouncing, even in the third week of January. Tried it the fourth week of January and finally closed below it. So to me, the market was sending a signal that large players were continuing to distribute stock, especially as they saw earnings declining, the possibility of interest rates going up, and the dollar getting stronger in that perfect storm. And that's why I got more cautious on January 30th looking at all this. Okay, so we know what happened. I got some hate mail for this one. The market actually went down to 1990, took out our stops and on a few positions, and then roared right back up to the top of the range. But let's look at the hard facts of what's happening. This is a new chart. Everything else I showed you was my analysis from January 30th. This is a new table from Shiraz, who is our earnings guru here at Zacks. And this is his data as of Monday, February 9th, just looking at the evolution of estimates. So what you're looking at here, the green bar is what are the earnings estimates for Q1 of 2015? And the orange bar is Q2. How have the estimates evolved? Well, back in October, all the way on the left here, I get my cursor to work, we were looking for 10.8% earnings growth in Q1. Well, you know, that was just pie in the sky, and obviously the oil bear just clobbered these estimates. You know, it took, if you take say 20% of the S&P and knock its earnings down 50%, you know, there's your 10% earnings wallop to the S&P, which brought us all the way to the beginning of this week, where you're looking at negative earnings growth for Q1 and Q2 of over 3%. So this data just proves that what we saw coming with earnings estimates getting knocked down is real. And my question is, why aren't more large investors afraid of this, especially with the interest rates rising sooner and the dollar getting stronger? All right, so this is my big question. And this is what, you know, some people might think, that this, you know, our tax break at the gas pump, can that reverse estimates back up? So we're actually down to $117. Full year estimates on the S&P, $117. That, you know, that's basically zero earnings growth. So can the tax break at the gas pump, can that boost other sectors up and get us back into the 120s for full year S&P estimates? Because, you know, if they can't, then you're looking at some very difficult math here. Let's look at the math. Let's say if we are anywhere from flat to 5% earnings growth for this year, what will the market pay for that? I mean, just the simple math of a 16 multiple on $125 aggregate EPS is S&P 2000. But we're not even there yet. We're looking at $117 in earnings for the S&P in 2015. That's where the estimates are right now. And to me, they have as much risk of going lower as they do of going higher. We haven't seen these other sectors improve from the so-called tax break at the gas pump. Now, we could, it just hasn't happened yet. So to me, if the market was going to run in advance of the bad news, it should have done it by now. And I thought that the first week of February would see that breakdown and we'd head to 1900. Hasn't happened. May not happen. We're sitting here back up at the highs above S&P 2060. So just to review my perfect storm for stocks that still is not unfolded, but could, and might give you pause to think about if you should take some profits. Here's the earnings deep freeze. S&P EPS of 117 is the estimate for 2015. That represents zero growth, friends. Zero EPS growth. Because we're going to be lucky if we come in at 117 for the full year 2014. Once Q4 is fully in the bag, will it even be 117, which is the, if you use S&P estimates, that was their calculation. I don't even know if it'll be there. So if we're already looking at flat earnings growth for S&P 2015, that's a problem. Heavy headwinds, the surging U.S. dollar, especially with ECB QE. And then the ICE. The ICE is the FOMC. They're highly motivated to get off zero. And why do I say they're highly motivated? Because if you see the shift in tone in the speeches and in their language, you're starting to hear more Fed governors say, yeah, zero rates aren't right for this economy. This economy's strong. Look at the job growth. We can get back to our 2% inflation target. Now, that wasn't exactly the message we got from the last FOMC, but then what have we seen since then? Since the last FOMC, we got a ton of strong jobs data in the revisions, and the jobs market is the strongest it's been. If you look at it on, say, a 3-month rolling basis, or even the past year, we're seeing some of the strongest job growth in, say, 10 years. And so that has these Fed governors going, listen, we probably shouldn't be at zero rates. We need to start this process now, because I don't want to be the guy that left rates at zero when inflation took off. And I think that's all the way they feel. So even it's making the doves nervous. All right, so that's my perfect storm for stocks. You decide for yourself. I think until we break through S&P 2090 and really have a push to the upside, we could continue to be stuck in this range in February. All right, thanks for joining me in the kitchen.